Okay, Signet Jewelers, company which was established in 1950s. It has several brands. Okay, and let's have a look how many stores they have. Altogether, they have 3,600 stores, primarily in US, UK, and Canada. Okay, and they have several divisions, as I told you. Now, the directors own less than 1%. Actually, in Michael Kors, directors own 5% of the stock. Okay, which is pretty good. Okay, here it's less than 1%. So let's have a look at fundamental analysis of this particular company. So timeliness is 2, so it's pretty good, and same as Michael Kors. So Value Line believes that this company has the highest potential, one of the highest potential to grow within the next 12 months. Safety is average, 3, so it's not better, not worse. The good thing about them, they pay dividends. Okay, we can see that they constantly increase the level of their dividends. Now, PE ratio is also 10, but the PE ratio was actually, wait a second, I forgot to look at the PE ratio of Michael Kors here because I wrote it down. PE ratio, where was it? No, actually, I don't see it here. I think it was about 8.9, something like Shane 9.9. Okay, Shane knows 9.9. He analyzed that company. Okay, so here we're telling 10, but in reality it's below than 10 because Shane, are you talking about Michael Kors or are you talking about Signet already? Because it has to be lower because the current price is $67, so it's $13 below that level, so it has to be about maybe 8.5, something like that. Okay, now Value Line from that price expected it to grow to $135 to $200, so which represents 15 to 26% annual growth. That's capital growth. Okay, so if you buy it and hold it, that's based on them. Okay, and let's have a look at what they have. So sales and earnings again from 2008. The interesting thing what I've noticed here, the sales level in these 3 years was nearly the same. Like it was growing, but look, 39.26, 39.88, 38 here. So a slight drop. That's the only drop they had. And but here was a loss, and I wasn't sure why that loss was here. Of course, it could be related to the economical situation when people losing their jobs and market is collapsing. I don't think they're going and buy jewelries. But who knows, maybe otherwise they think, okay, the inflation and dollars will be disappearing or money will be disappearing, let's invest them in diamonds. Who knows, maybe otherwise it is in Russia, that's what they do. As soon as something happens bad, they go in and invest money into some kind of gold, silver, jewelry, which not going to depreciate. Okay, so, but what I believe here might happen is because the company was going public, quite huge expense was with bringing company to the public, to the market. So that's why this expense might be here, because next year, look at this profit, it jumped from minus 60 cents to nearly $2, and then it keeps growing every year since. So that's what we can see. 39, 43, 48, 52, 71, 82, 93. So the earnings per share, they're growing, and they expect it to be $122 per share. Then we look at earnings, sales. Earnings, 230, 370, 430, 450, 560, 680, 740, 790, expecting it to be around $11. What do you say about this? Do you like that? I'm sure you do, right? So it's fantastic growth. That's amazing. The question is, now, if everything is so good, what the heck is going on? Why the price went from $150 in 2015 to current levels of $67? What's the problem? Okay, while I'm explaining further, please write down what kind of problems do you think happens here, happened here. Like there are 3 problems. My kind of hint for that. One is general outside problem. So, and then two inside problem within the company. So, and who knows, write it down. I'm just curious if you know that or not. Now, then the next thing we see dividends. So they pay dividends and they increasing these dividends quite well year after year. So it's kind of good. Book value, what we can see with book value grows as well, but not as much as those. And actually it's dropped during last year. So they sold some assets, or depreciated some assets, or maybe wrote off goodwill or something like that. So we have to look at this, and that's actually a good thing to see it, because maybe we can see that the growth, there is no growth in earnings because they wrote off something here, goodwill, and that's what we can see only by analyzing balance sheet. Okay, maybe they wrote off inventory. So what happened here? Or maybe they wrote off bad debts, which is also debts wouldn't be good for us. Okay, but we have to think where $3 gone. Okay, because it's 10% of book value disappeared. Okay, for us, it's kind of a good thing to have a look at this. Now, I always look at sales level not only per share but also per company. And the interesting thing here, look at this: 5.7, 6.5, and then 6.4. So the sales growth is actually less than last year, like 2016 less than 2015. But when we look at per share, it's actually nearly more than 10% growth. So, and Jeremy already mentioned that most likely it happens when company buys back shares. Let's have a look. That was 79 million shares and now 69 million shares. So they bought off the market, what, nearly 15% of the outstanding stock, which is amazing. So the company is buying quite a lot of stock, which is like, I mean, guys, it's really, really good. Okay. Now, the next thing what we look at is profit, net profit. So they can see that despite the sales drop, the profit still growing, 540, 560. So when we saw Michael Kors, we had a different story. They had growth in sales, but they had their earnings dropped. But here we can see it dropped in sales level, but we can see still growth in earnings. This situation is much better for us, like investors. We'd like, even if the share like company sells less, but still keeps the profit growing. Okay, that's a good thing. And then we can see that the amount of stores, they're increasing. So they're not closing stores, they're building it up. And look at this, it had 190 for quite a while, then 350, then 360, 370. So they opened the stores and they're planning to have 400. So it's a good thing about it. And I presume this type of market, people prefer to buy jewelry in a store. You wouldn't pay 3,000 for diamond ring if you see it online, right? You want to come, you want to try, you want to put it on your finger, and etc. etc. So, and I presume it will pay off. So they have less competition from online markets. That's kind of I think good. But their net margin is pretty low, 8.7%. Actually, it's moved higher now. That's why probably having less sales, they managed to have still higher earnings because their margin increased. It's again difference. This difference between Michael Kors and Signet, and they're planning to go to 9.7. I don't know if it is possible because look, they never had this type of margin before. The question is why they are saying that they might have it in the future. So I question it personally. Okay, so that's the thing. Okay, here it's all clear. Let's go to their capital structure. Now we see they have 1.6 billion in debt, quite significant based on their market capitalization of 5.6 billion. So it's about what? About 30%, something like that, right? Of the debt level. If we looked at Michael Kors, it had only 5%. Here we have 30%. So it's much higher debt. For us, it's more important to know, are they able to pay their debt? Okay, and we can see the due in 5 years, 1 billion. Okay, so we need to know, are they able to generate this profit or do they have cash in order to pay it off? Let's have a look. Where is our net profit? The net profit 565 million annual. Okay, so within 5 years they will generate about 2.7 billion in profit, and if they have 1.6 billion in debt, so they will be able easily pay this debt, and they will have another $1 billion available to like pay as dividends. Okay, so it's not a problem for company. Company can handle it. Okay, so that's a good thing about it. All right, this part of value line report, is it clear for you guys? If yes, let's continue further. Okay, that's what we can see here. Interesting thing, like current situation, current position. So it's current assets, current liabilities. So what we can see, the current assets level was 4.4 billion, 4.5 billion, 4.5 billion, about the same. Okay, and the same level of current liabilities, 1.3, 1.1, 1.3. Okay, so it's about the same. But look at this level of cash. They had 193 million, then 137, then 82 million. So nearly 110 million disappeared out of this lot. Okay, even current assets grew, but the cash disappeared. Where did the cash go? Because for us, especially if we know the company has to pay like debt, right, repayment. So for us, it's very, very important. Where did the cash go? What's the ideas? Where do you think the cash went? Correct, Peter. Yeah, Anlan, correct, completely. Yes, they bought shares. They bought 15% of their shares, and they're going to keep buying them for the future. So that's why both companies keep buying shares. So it gives a certain opportunity that it might push the price up as well, okay, because they buy shares themselves. Now, the other question, that's what they see, the annual rates, the growth was sales 12%, the earnings 36%. So we can see that earnings were growing always better than sales. Then we can see that in the future, they are planning 10% growth in sales and 11% growth in earnings. So they reduced their earnings growth. And that's kind of pretty, like I trust these numbers. This number is very difficult to believe sometimes when you see that type of growth, okay, every year. It's not sustainable. This growth is sustainable. Okay, so that's about this particular company. Now let's talk about their problems. What happened? And before we do, okay, probably before that. So we analyzed that that's a quality company. Okay, we looked at this, and we saw that it has steady growth. It has good revenue. Debt is manageable, right? So everything is solid there. They have quite huge reputation because they're on the market from 1950s, several brands, and so that's all good for us. Okay, it gets one of the highest scores, points 47, 50. Now, from undervalued point of view, I'm not going to go through these details, but the ranges are between 84 at the lowest point to 207. That's what we can expect it to be between, and it was already at 150 before. Okay, and current price 67. So similar to Michael Kors, it's actually below the lowest average level which we can expect. Okay, so it's already below that price. So it has a high potential to grow. Okay, so that's why we get 52 of 52 in this type of range. So it's the undervalued company, and the earnings 25th. So that's what we can see. Now the question is, what do we do after we analyze that? So we found good solid company, like quality company. We found that the price, current price, is quite low. It's fell, and it becomes undervalued. What's the next stage? What do you do, guys, after this stage? What's your next step? What would you do? Like, if you're thinking of buying some shares. Okay, Fraser, technical analysis. Who else? Search for the cause of the past drop. Peter, you're absolutely right. Yes. Fraser, you're right too. Technical analysis, the next stage. But before you go there, you need to understand what's the reason for the price drop. Because if the problem is solvable, the problem is temporary, okay, and you know that it's going to be solved, it means that price will recover. But if the problem is not solvable and problem is going to stay there, most likely the price wouldn't recover. It will stay the same, or even worse, it might go down. Remember all this Nokia in 2000, after 2008, when it was a solid, great, fantastic company, but it was a value trap because it went down in price. But then what happened? We thought that, all right, this company is losing their market because of general problems on the market in 2008. But nobody from management wanted to see that this company is losing to Apple and Apple is gaining the share. So when you see in the same industry, one company is growing and another company is going down, so you definitely understand that something is wrong. If the whole industry is going up and one particular company is not going up, it means that something wrong with this company internally. Okay, and you have to analyze it. Maybe it's a product, maybe it's management, it may be marketing strategy, maybe customer service, maybe something else. Okay, etc., etc., etc. So Signet has three problems, I told you. One of them, external problem, and we already discussed that. It's similar to Michael Kors and similar to Will Summoner. It's general market weakness, that people start spending less. Okay, and in general it's happened. Okay, it's not only in Signet, and we're told that all these companies, they move cyclic, like in cycles. Okay, so sometimes they're down, sometimes they're up. So we believe that at the moment they are on a downturn. Okay, so it means that company itself, Signet, cannot do anything about it. I mean, if in general people stop buying like products all over the world, they're trying to save money because of maybe president's elections. They wasn't sure what is going to happen. They're not sure about their job. They decided, okay, we need to create some savings, or maybe we have to pay off our debts. Okay, and, like, I mean, at least to have less debts before that, and that's what happened. It's first reason. Now, this problem is definitely solvable, and it will affect all of them. Okay, and the worst companies, they will go down. The best companies will stay up and acquire market. Now, but the other two problems which SIG has, first, is they accuse, like not accused, a lot of investors start talking that Signet giving too much credits to their customers. In 2011, Signet introduced the credit facilities for their customers. When you buy jewelry, and jewelry quite expensive, they're providing a 36 months terms for their credit. So you can buy it now, but you pay within the next 36 months. And what some investors are worried about is that those clients, they wouldn't be able to pay it back. Okay, and that's where the reason of sliding down from $150 and downturns, like altogether with a general weakness. Okay, that's where it started going down, and a lot of discussion. If you go to Seeking Alpha, you will read a lot of articles regarding this particular topic, and they're saying, oh, that's bad, and etc., etc., etc. And here you have to understand how it works. I mean, personally, what I think, okay, that could be solved. Okay, and usually the rate of debt, of course, it depends how you agree, but you can sell bad debts for 75% of the total debt. So if somebody owes you 1 million, you can sell it for 750,000. And the company which like buys this debt, they start already implement all these debt recovery strategies. Okay, that's what they do. Now that's one strategy. That's how they can get rid of that debt. But another strategy, I'm not sure how the policy is structured. For example, in Russia, it's quite often if you buy something on credit, they have these terms and conditions. For example, if you get a mortgage and you are not able to pay the mortgage, your house is going to be repossessed. So when you buy high-time items like cars, they can repossess it. Not for every position, but I'm just wondering, if they have this thing like jewelry, if you buy a jewelry, you don't wear it every day. You might wear it 3 times, 4 times a month, or maybe even less if it is expensive jewelry. So the quality of it doesn't go. So I mean, if a person cannot pay, apply the fines for this person and get the jewelry back, and then polish it and sell it again. So I'm not sure if they do it or not, but I think it's one of the ways to solve this problem. And secondly, I don't see it's like a problem, because majority of huge businesses, they sell through credit. You buy TV through credit, you buy computer through credit, you buy furniture through credit, car for credit, like majority. And if people are not able to buy in cash jewelry, so that's the only way to do that. So I don't think it's a huge problem personally. That's my opinion. Again, it's much better to discuss it further and analyze it yourself, because when you invest, it's your money. But that's one problem. And the third problem was that they were accused that they're harassing women. Okay, that's a huge accusation. And you know that at the moment is everyone is talking about women's rights, especially in civilized countries. And of course, when somebody accusing you like that, it could be a big problem. Like, I mean, for the company, that could be fines, etc., etc. And but it was like, when you look at the stock market, I'm just going to jump it further and just show you. Here, the company was at $72 and dropped because there was a TV program and it told about this lawsuit that they are sexually harassing women. So a few days later, the management came back and they told, look, that producer was completely wrong. Nobody ever accused us in sexual harassment. Whatever they accuse us on, that we don't give equal opportunities to women, which is also false, because we are giving opportunities to women, and 60% of our force are women, and we have women in management, we have women everywhere. So whatever is accusation like that, it's not true. Okay, and so the share price moved up 11% in a day, next day 8%, but then it's finished again the same level. So that's what happens on that particular news. Okay, and about this. So at the moment, this situation is going to go around, and there are a lot of talks about this harassing women. But the interesting thing that this issue first was kind of introduced in 2008. So it's not a new issue. They're talking about already for nearly 9 years, and courts several times dismissed this case because they didn't find any ground for those cases. But sometimes it's again emotions about it, publicity, etc., and the market reacts on that. So that is the third reason. So we have 3 reasons. One, general weakness on the market. Second one is fear of investors that they provide too many bad debts, they provide credits to the customers which are not able to pay, and it will be a bad debt. And also they're afraid that company can be liable to some court issues because of the women harassment. Okay, that's 3 issues. And if you believe that those issues, they're serious and they might affect the profitability of the company, of course you stay away from the company. But if you think that those issues, they're not going to affect profitability of the company and eventually they will go away, so that's probably the good time to invest in this particular company. Okay,